Welcome to Traders Corner. Joining me, as always, is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we're going to talk about the S&P500 in a moment because that is the basis for the trade that you've set up this week. But if we start on the top 40, it seems that you're a bit concerned about the prospects for the next couple of months.
Yes, that's it. So we're switching it around. Normally we look at the S&P500 first and then we look at the top 40 and move on from there. But because we are doing an option structure on the S&P500, I thought let's start with the top 40 and then we'll get into the S&P 500 and get a bit more meat on that, as it were. So here's a chart of the top 40 that's up on the screen at the moment. And what you can see is the same as what I've been talking about in the previous couple of weeks. We still do have this upward sloping channel evident on the market. These slides were taken a couple of hours ago, and in fact, since I've done these, we've had quite a serious daily reversal down on the top 40 future, down from the upper boundary of that channel structure over there. So that may very well still indicate that we could see a little bit further downside here. Obviously, a lot does depend on the rand and what the currency does. We have had a fairly weak rand during the last couple of days, so that has propped the market up. We'll have to see how the rand performs in the near term. I mean, the rand is pushing up against its 200-day moving average, and if it starts to turn lower from here, then possibly, maybe the rand strengthens a bit, but we don't know at this stage. In terms of the top 40, just do keep in mind we have an option structure in place which is running out to the September futures closeout, and that is illustrated on the right-hand side over there, where we've got the payoff profile of that option structure. And do keep in mind it's a put spread structure, which we did a number of weeks ago, but we've also gone long of two all-me futures at 45,820. So those two all-me futures are in the money now. But the overall payoff of the options as well as the all-me futures are illustrated on the right-hand side there. And you can see the closer to 46,000, the more profitable we are on the structure.
Just if there is a bit of a crack in the market, will there be any changes that you make to the all-me contracts that you have?
It's possible that I could look to exit those two all-me contracts. And in fact, based on today's reversal pattern on the market, I may very well look to exit those two. But I'll have a look and see how it's trading by the end of today and maybe look at what to do with those tomorrow.
Okay. All right. Then moving on to the S&P 500, Garth, which we normally start the show as although you've got a chart, you've got a slide up there that I didn't talk about, and I think it's Fibonacci numbers that you wanted to mention.
Yes, we can quickly look back on the top 40 future here again. Just the red boxed area that's indicated on that chart there is where the Fibonacci ratios come into place. And what I mean by that is if you take the whole move down from the late May into middle of June, that whole drop that we saw in the market, it has now rallied into this Fibonacci zone. And we call that an ambush zone. And that is where you get between a 50% retracement and a 61.8% retracement of that whole move down. And that's quite often an area where you will notice that a reversal might occur and then a change of trend happens again. So it's just notable that we had this reversal occurring today in that red boxed area, which is exactly that ambush zone that I refer to.
Yeah, okay. Well, moving on to the US markets, we normally start talking about them, and they have been quite steady, but you think that there is possibility for a pullback, and that's how you want to set up the trade that you're going to talk us through this week.
Yes, that's right. So here's the chart of the S&P 500, and we look at this each week, and nothing much has really changed with it. You can see above 2,400, that was a bullish break. The market has been coming back. The 2,400 area should provide some support on any weakness in the near term now. And that's all good and well. But what I'm quite interested in here is looking at the seasonality on the S&P 500. And I've got two charts here where we're going to look at the seasonal patterns that have been evident on the S&P 500 over a number of years. So this one is from equityclock.com, and if you're ever interested in seasonal graphs on different products and indices and what have you, go and have a look at this website. It's very, very interesting. They track seasonal patterns on all sorts of indices and products over a number of years. So this one is 20 years worth of seasonal history on the S&P 500 index. And what's quite interesting to note is that this is a pattern that the market typically seems to follow year after year after year. Obviously, not every year is the same, but if you average it out over 20 years, this is the kind of pattern that the S&P 500 has typically traded in over a 20-year period. Obviously, you start the year with zero growth, 0%, and then you have fairly strong move up through the second quarter. Then the middle months of the year are very dull and choppy, and there seems to be weakness into the third quarter of the year. And then you have this very powerful rally at the end of the year, and that's where your whole Santa Claus rally comes from. And so it's quite interesting to note the seasonal pattern. And we sit right now in July where, we're staring down the possibility of a seasonally weak period in the next 2 months ahead of us. So that's the one chart. The other one is also a very similar looking chart. It's just from a different source, topdowncharts.com. And what this one is, it also shows the seasonal pattern of the S&P 500 in black over there. That's also over here. We've got 26 years worth of history here. And notice the red line on this graph is the S&P 500's trading action for the year to date. And notice how closely correlated it has been to its historical pattern over the last 26 years in this case. So once again, we sit in a situation now where we're in July. We've got August and September and October still coming. And historically, if these seasonal patterns are anything to go by, it's quite possible we could see market trending sideways and maybe to slightly lower in the next 2 or 3 months or so. So if that is the case, and I think it quite well could be the case, also given that we're going into an environment now of quantitative tightening and we're looking at some possible tightening from the Federal Reserve, I think it's fairly feasible to think that we could actually see a little bit of softness in the S&P 500 in the near term. And I'd like to take advantage of that. So we've created an option structure to do just that.
I think we're also very simple creatures. It's always post holidays. I'm sure everyone's depressed and feeling lackluster about life. I'm sure there must be some sort of correlative effect.
Well, there is. In fact, I mean, those middle months of the year where the market is a bit dull to ever so slightly weak, it's always the winter months here and the summer, Northern Hemisphere summer. And I don't know how much those weather patterns have to do with stock markets these days, but the evidence is there that those are seasonal patterns that still seem to be relevant today.
Yeah. Okay. So this is setting us up for the trade, and you're also just going back to this year's graph.
Yeah. So this is our S&P 500 graph again for the year to date. So we start in January, and all I'm really wanting to do is say this yellow shaded area over here is where I want to try and participate. If the market moves lower into that area over the next 2 months or so, I would like to make money out of that. So what we're doing in order to effect this trade is one of these put spread option structures. I know I've mentioned on the show a couple of times in the last few weeks that I might look to do something on our offshore portfolio around the S&P 500 and might be an option structure. We've got obviously the one we spoke about on the top 40. We've got a put spread structure open there, which is looking very good for us. I want to now do one on the S&P 500, and this is a great structure in my opinion. It gives us a very good risk to reward ratio, which you'll see as I explain the logistics and the mechanics of this trade.
I mean, and the logistics are there's always a couple of legs. So what's the first leg?
Yeah, so these things do get quite complicated, but I'll try and make it as simple as I possibly can. Just looking at this diagram quickly, the numbers along the bottom there are the levels on the S&P 500 in 25-point increments.
Okay.
And then on the left-hand side here, we've got the profit and loss. So above the line, profits in increments of $500 and below the line losses in increments of $500. So the first leg of the structure that I've done is I've gone long of a put option on the S&P 500 with a strike of 24.30. Now that's pretty much where the S&P 500 is trading right now. So we're talking about an at-the-money put option at this stage, right? I've bought 4 of those and they're $436 each. And this is basically on today's pricing, right? So 4 of those at $436 each implies that I've spent $1,744 in premium on this leg of this trade. And you can see that red line indicates the payoff profile of of that option over there. Above 24.30 is where we pay our premium of $1,744, and then below that level it starts to make money. And that put option will make money all the way down to zero if the market goes to zero, which it's not going to do, of course. So we therefore say, well, why don't we sell away some of the downside participation, because we're effectively buying a put option that gives us participation to zero. We're paying for all of that, but we don't need all of it. So let's sell away some of the downside participation in order to earn a bit of premium in our account. So the next leg of the structure that I've done, therefore, is a short put option with a strike of 23.70. So in other words, I've now sold short this put option. Instead of buying one, I'm selling one. I've sold it at a price of $251, and again, I've done 4 of those. So in total, I receive premium earned of $1,004. All right. The next leg of the structure is also a short sale of a put option further out the money.
Okay.
In this time, it's 2280 is the strike.
In other words, a bet, as it were, that the S&P would collapse to 2280.
Yeah, well, I don't think it's going to go there.
Yeah.
That's why I'm happy to sell away
Exactly.
the downside in that case. And do keep in mind, even if it does go there, I've already got the long put structure, which is the red line,
Yes.
which is already working for me by that stage, and I'm making money on that. So I've sold short another 4 contracts of the 2280 puts. There I've received a premium of $125 for each of those. So there I get a total premium income of $500. So what you can see here is I've received $500 and I've received $1,000, right? And I have and I've paid away $1,744, which net off it basically means that I've paid away a total premium of $240. Now, that's now the overall payoff of all the different legs together. Once you work them all out, what the net payoff of the structure will look like, and it's exactly what I want it to be, because basically below 24.30 my structure starts to make money. Above 24.30 I can only lose $240. I lose my premium,
Yeah.
which is fine. So if the market continues to rally to the moon, it doesn't matter. The worst I can do is lose $240. If the market does go lower, like I expect it will, it starts to make money below 24.30. It makes its maximum profit between 22.80 and 23.70.
So it's a fairly wide band.
It's a fairly wide band, that's right. And I mean, effectively, the structure only will start to really lose money and go into a danger zone down here below 22.25. So we're talking about 10% downside participation here on the S&P 500. My maximum profit is $2,160. So if we look at this in terms of a risk to reward ratio, my risk is the $240. That's the premium that I'll lose irrespective. The possible reward here is up to $2,160. So that's a 9-to-1 risk reward payoff, which is a very, very decent risk to reward ratio. And I think, based on the picture that I've sketched in the background and whatever, I think it is fairly feasible that we see that sort of the market moving towards that area, and then we're quite nicely positioned for that.
Yeah, and that's sort of once again illustrated by the actual market activity that's taking.
Yes, that's it. So here's our chart of the S&P 500 again that I showed earlier, and I said to you that I wanted to participate in this yellow shaded area, basically below 24.30, in other words, basically below where it's trading at the moment. And there you can see the option structure overlaid on the right-hand side there. Above 24.30 we lose our premium, which is $240, and that's less than 2% of our offshore trading capital. And then we can make our profits below 24.30, and we can make nice chunky profits in this sweet spot zone here, which is indicated there.
And I suppose it's especially nice because a 3 to 7 or 3 to 10% correction on the market isn't massive. No. And if you were just trading this fairly directionless market and you hadn't maybe taken a position either way, you'd feel like nothing's happening. And yet this actually could really bump up any sort of profit from a drop in the markets where it probably wouldn't if you'd I don't know, or maybe just sat in the market.
You're 100% right. What I really like about doing these kind of structures is that because my risk is defined up front, I don't need to have a stop loss because I know what my risk is. And because of that, I can also take a slightly larger exposure that I would ordinarily take with a naked short position. And to be honest, this year, I mean, it's been difficult. We make no bones about that. The directional trading this year has been very, very, very tough. I've been doing quite well out of these put spread structures, both here and overseas. In fact, that's the only place I've really been making money this year is on these option structures.
Unfortunately, on personal portfolios. So let's hope for the show's portfolio, this one works out. Garth, just to wrap up, how do those portfolios look? And then you've got a course coming up.
Yes, so here's our South African portfolio. We've marked to market our top 40 put spread there today. And remember, we went short of Barlow World last week. That trade is working out. We're up $918 there. So we're up close to 19% for the year to date in our South African portfolio. And then our offshore portfolio here is now showing a loss of minus 6.7%. Do keep in mind that is now taking into account this premium that we've paid away on the option structure on the S&P 500. So, ideally we obviously need this structure to pay off nicely for us so that we can come back onto the right side of the ledger on our offshore portfolio.
Yeah, and then you've got a course coming up on the 19th of August.
Yes, I'm doing a high probability trading course on the 19th of August in Johannesburg. So anyone that would like to attend, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Great, we have to leave it there. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.